What a way to end the week. A very busy trading day. Lots of action as the Dow looks like it's settling about 41 points to the negative. Let's get right to it. We have Larry Shover. He's in the pits of the CME. Mark Lucchini has a bearish outlook on the markets, but that doesn't mean there isn't money to be made. He'll tell us where. And Adolfo Laurenti blaming structural issues for today's jobs numbers. We're going to bring all these guys into the picture immediately. Get right to it with Larry Shover at the CME. So, Larry, despite the day's job numbers, we had quite a comeback in the market. I would say that that is a buy cue. The fact that the market would come back even fighting these lousy jobs numbers. What do you say?
I say traders and myself, we're paralyzed right now. I mean, we're in a situation that, in my mind, is inherently unstable. We have wobbling growth momentum. We have an earnings season that we have no idea what's going to happen, unprecedented monetary easing, and what's going on with Europe. However, the market continues to go up. Like I said 6 weeks ago, I'm still in a step-aside mode. I'm happy to be a pedestrian right now, waiting for growth metrics to kick back in.
All right, but Mark Lucchini, on the other hand, we did see the market kick back. It kicked back significantly, coming from a 171-point deficit to down about 40 points. Doesn't that show that there is this unrelenting momentum for buy in this market?
Well, I think it certainly is supportive, Dave. I mean, not to sugarcoat today's number, but at 88,000. But if you look over the trailing 3 months, it's 168,000. The work week actually expanded a little bit. Average hourly earnings were flattish. So, you know, this in and of itself doesn't necessarily indicate a pattern, but it's certainly worrisome. That said, clearly the bias at the moment seems to be for the market to want to work higher, and it's still very much in a show-me state relative to any economic deterioration that some that are on the more bearish side are worried about.
All right, well, Adolfo, let's get to the bearish news, of course, which were those jobs numbers. There was no way to sugarcoat them. They were bad numbers. Of course, we did have a 1-point downtick in the overall unemployment rate. That's just because people left the workforce. You say don't expect the jobs market to do much better in the near term. Explain why.
Well, I think there are two fundamental reasons. One is a short term, one is a longer term. Short term, I think there is still a lot of policy uncertainty that makes businesses extremely reluctant to go out and invest or hire people. I think the debates about the tax levels, I think the implementation of healthcare reform, all the rules and regulations that are still pending and do not really give a very clear guidance to business to step up. This in the short term. In the longer term, I think that what we are seeing, especially in the job market, is a long-term adjustment. That's why I call it structural. I think that the way that we do business in a globalized economy has radically changed. Many policymakers have been very reluctant to call these structural factors, but I do not think that what is holding back the economy at the present time is just a lack of demand that can be fixed by more stimulus. Yeah. I think there is a much harder work to be done, business by business, adjusting to the new economic realities.
Well, the money printing certainly hasn't helped the jobs numbers. We saw that with today's March report. Larry, I'm wondering whether these job numbers are some kind of indication of what we're going to see in earnings season. Are the weak job numbers an indication that we may have a weak earnings season coming up?
I think so, and I think most people, they dialed up the earnings per share number from $107 a share back in the end of 2012. Some people penciling $111, $112 a share. I think people are quickly dialing that back down to reality, maybe something closer to $109 to $110 per share. Again, that's for the collective earnings per share for the S&P 500.
Well, Mark, on the other hand, there have been some laggards in this market. Not everything has been straight up like a rocket. And, of course, obviously, you start with the number one laggard, which is Apple. Is now the time? The fact that Apple today had another down day, it was down about 2% at one point. Is it time to maybe take a bite out of that apple again?
Well, it's certainly at a very interesting level in here. From a technical perspective, it really needs to hold at this level. Otherwise, it could gap down another $40 a share relatively easily. But if you step back from the technical side and look at it from a fundamental perspective, I mean, the company continues to mint cash, $16 billion a quarter. It's sitting on over $137 billion as we speak. Its earnings are probably going to struggle until we get into a new cycle of product launches, which is expected to occur this fall. At today's price point, you're talking about a company that offers a yield to investors of above 2.5%, almost 3%. And there's some suspicion that we may very well see a dividend increase here in the offing. So as a consequence, I do think it looks pretty tasty, Dave.
Larry, I don't often ask you about specific stocks, but in this case, I'm going to. What about Apple? Is Apple the laggard that you'd go after right now?
Absolutely, and for three reasons. First is that it underperformed the Q1. That seems to be the magic. Number two, it's got a free cash flow yield of above 5%. That's compelling. Lastly, it's got year-on-year revenue growth. All that said, though, I'm very conservative. I would buy any stock, but I would hedge the stock with a downside put for the things that we just don't know about. I mean, it's a great fundamentals, a great time to buy it, but I'd also hedge my downside exposure.
Okay, Adolfo, we have a housing guest coming up. Let's talk about housing for a second, because if there's any positive sign about the overall economy, it is housing. What do you think about the future? Have we seen all the rise from that we're going to get, or is there still room to go up?
No, I think there is some additional room for improvement on the housing market. Remember, we have seen good numbers, but by extremely depressed levels. So the expectation is as this market stabilizes and normalizes, this will happen at a higher level. The news have been fairly consistently good in terms of prices, construction activities, sales. Of course, there might be a little bit of hangover because there are a lot of shadow inventories, those properties not brought to the market yet because of the low prices. Right. But overall, the sense is that right now housing is a bright spot in this economy. The question mark is, with no acceleration on the job front, how long this can last. Right. You know, I do believe it will last a little bit longer, but the job market are critical to see the improvement through 2013 and in 2014.
Absolutely. You can't get interest rates much lower than they are right now in a 30-year. We're going to be talking about that coming up. Gentlemen, thank you. Very good stuff. Appreciate it. Mark Lucchini, Adolfo Laurenti, and Larry Shover. We're going to see you in just a couple of minutes when the CME closes. You can hear them working up to that point right now. We want to know very much. The S&P futures are closing in about 15 seconds from now. Let's go right back to Larry Shover, the pits of the CME. Larry, I see a lot of guys hanging around there. What are the signs for Monday?
I think you're going to see a lot more hanging around. I mean, let's keep in mind, there's too many data points to give this market the benefit of the doubt right now. People need to see the earnings season. We have April the 8th, the start of it. We're going to see Alcoa, JPMorgan, Wells Fargo. It starts in earnest on the 15th. I think we're going to see a lot of tight ranges until we see the expression of the earnings season.
Yeah, and the question is whether this jobs report gives us any indication of the earnings season. Yes. If that is sort of predicting a weak earnings season, we may see that correction we've been talking about. Larry, good to see you, my friend. Thanks very much. Have a good weekend. Well, the White